Welcome back, everyone. Thanks for tuning in to this episode of What Are Your Thoughts? So I ended last episode talking about diversification versus concentration, and so I wanted to do a full episode on that. I have a great show lined up for everyone today, and the reason for this topic is really based on a few different things, and one of them is seeing posts on social media about people basically YOLOing or going all in or, hitting the lotto with any one investment, or I don't even know if I'd call it an investment, with one trade that they had made. And yesterday was the culmination. An advisor in an advisor forum that I'm in said that she had a client that was leaving her firm to start their own family office. And I'm not going to get into what a family office is today, but basically the client is leaving this advisor because they went all in on a certain investment. They put $2 million in and now they're worth over $500 million. So that may sound, it sounds insane. It sounds wild, but I just want to talk about the risks involved in doing that, and just really what would make sense for the average investor. I think in that case, this person was working at a tech company and their company IPO'd, and they got that initial $2 million or extra $2 million, and they put all of it into one investment, and they basically hit the lotto, literally. So just talking about that and what would make sense for young investors and investors on the cusp of retirement as they're building out how to invest their hard-earned dollars moving forward. So basically just defining each one. So if we start with concentration, right, by definition, that is holding very few investments, or even maybe one investment, and it's generally in the same sector, industry, or specific niche of dollars of that investment inside the marketplace. So they're basically making one or a few bets in one specific area, one concentrated area, and the hopes of getting massive returns way over and above the market. So that's concentration. On the other hand, diversification means holding a slice of many different, could be stocks, sectors, asset classes, and asset classes you can think of as like U.S. big companies, U.S. small companies, international companies, emerging market companies like, Brazil, India, China, companies in those areas. Real estate, so having a slice of each of those different asset classes, we call them. And that is what it means to be diversified. And so if we were to talk about the pros and cons of each, and we started with concentration, right? The first pro of concentration is home runs, right? Being able to put yourself in position to earn super high returns. Well, that sounds awesome. However, if you've been following along, the downside of that is that, generally speaking, more return comes with more risk. And so you put yourself in position to potentially lose all of that money, or at least a higher percentage of that money, being in a concentrated position or a concentrated portfolio. So that's the first one. The next pro is that you could argue that the fewer investments that you hold, the easier it is to track, and you can develop a deeper understanding for each one of them. That could absolutely be true. The next one that goes hand in hand with that second one is that you can be more selective of the investments that you buy. So one classic, topic or analogy that Warren Buffett would make was that if you had a punch card and you could only had 20 punches on it, you could only buy 20 investments throughout your entire life. Knowing that you could never go over 20 investments, you would be very selective about that. And I'll talk about a little later, the misconstrued thought process that goes with that, and why that might not work for everyone. So just recapping, right? The pros: potential for higher return. Fewer investments means, generally speaking, it could be easier to track, and you could develop a deeper understanding of the investments that you hold. And then the third one is more selective. You're more selective with what you buy because you want to make sure you get it right. On the other hand, cons, right? I talked about the first one. There's going to be greater risk. It's a fact that, generally speaking, again, I'm going to say it, I feel like almost every episode, that higher returning, or putting yourself in potential to have a higher return than other investments, generally comes with more volatility and more risk. So you have to know, like, the purpose of this explanation is to help investors gain financial knowledge so that when they make their investments, they know what they're getting into. I had someone on Facebook say, I just bought my first stock, and it was Dogecoin. And first of all, Dogecoin's not a stock. Second of all, after they bought that, it tanked. I'm just like, I felt bad, but at the end of the day, investors should do some due diligence on how their portfolio is constructed or how it works, right? I'm trying to have people gain financial literacy so that when they make these investments, they can at least have an understanding of how they could perform. All right, sorry to get off on a tangent, but moving forward to the next con of concentration is that you can absolutely let emotions get involved and fall victim to that lotto ticket mentality. You see a lot of posts, it's sexy online. You can see, investors hitting home runs. I just want to make the point that for those investors that hit those home runs, there's hundreds of others that did not. You can find on Reddit or Instagram that people post their losses as well, and it's sad. It honestly is just sad. The next con is that and I've said this before multiple times, that investing is not like other things in life when it comes to due diligence equaling higher returns. And I often use the basketball analogy. If you shot 1,000 free throws every day for a year, at the end of that year, you can probably assume that you will be a better free throw shooter than when you started. Now, again, investing, even with tons of due diligence and tons of confidence, an investment can still go down. So if you're going to hold a concentrated portfolio, have the humility to lick your wounds and exit the investment when it goes against you. And that's important. All right, I wanted to just cover the top 3 pros and cons there. Let's move on to diversification. I'll talk about the pros and cons of it. The first pro of diversification is less risk. So if we're talking, I don't want to get too technical, but if we're talking standard deviation or risk, that having a diversified portfolio, there will be less or fewer amount of standard deviation, fewer amounts of risk inside of that portfolio. And the reason for that is because you're holding different slices of different investments that all perform differently. So you could have, and I'll put a link to this in show notes, there's one of my favorite websites has, I guess I call it like a quilt, but basically it lists different asset classes, U.S. large cap, real estate, emerging markets, et cetera, year over year. And it talks about, or it just simply lists the return, positive or negative, and the percentage for any given year. And it's color coded. And so what you'll see is so I have it pulled up here on my screen over here. I'll link it in the show notes. And for those that are watching on YouTube, I will put a photo of it up and link it in the show notes as well. But in 2018, emerging markets was the lowest performer at minus 14.3%. And cash was actually the highest at 1.8%. The following year, 2019, large cap was the highest as far as return goes with 31.5%. So if you held all emerging markets stock and you were concentrated in just emerging markets, you were down 14%, where cash was up. And in 2019, you underperformed the highest returning asset, which was large cap, by 10-12%. So the thought here is that by holding a slice of each one of these asset classes, that you will not only decrease the risk in the portfolio, but you'll put yourself in position to capitalize on the investments that are up. You're still going to have a slice of those, but the investments that are down, you're not going to hold enough to where it's totally going to be detrimental to the portfolio. So I just wanted to make that point. And if you go to the link, you can hover over them and see where they see which portfolios and which asset classes perform the best and worst. And they have one on here for they call it an asset allocation portfolio. And it is a breakdown of like 15% large cap, 15% international, 10% small cap, 10% emerging markets, 10% real estate, and then 40% bonds. So it's like a 60-40 portfolio. And over time, they break it down and it generally performs right in the middle of the pack. So you could think of this as a pro or a con of diversification, is that you're never going to, hit home runs, but you're also never going to experience, well, I shouldn't say never. You're by definition, you're never going to experience the lowest returning portfolio, because you're not going to hold 100% of one thing that will be the worst performer. So you're never going to hit home run. You're never going to be the highest performer, and you're never going to be the lowest performer by definition when you hold a diversified portfolio. And that's key, because a lot of my clients, they don't want to take on another March of 2020 or a 2007, 2008 where the markets went down, right? A loss generally feels 2 to 4 times worse than a gain feels good inside of an investment portfolio. So holding a diversified portfolio generally does make sense for a lot of people, especially those on the cusp of retirement. If we move on, the quilt, by the way, the quilt will make a lot more sense when you go to the link. It was probably a little confusing when I explained it. But basically, it just shows different asset classes and their return year over year, and then compares it to a diversified portfolio, which lands somewhere in the middle in terms of return. All right. I just basically said for pros and cons of a diversified portfolio, and I put an example here in my notes when I was prepping this episode. Talking about if you held just a 50-50 portfolio, one of the investments returned 10% over a year and the other one returned 0. Well, that total portfolio return would be 5%. So you could look at that as, I underperformed, I missed out on 5% return. Or you could think of it as, I had way less volatility, way less risk inside of that portfolio, and I'll take my 5%. And again, it's important to know what portfolio or what investment you're getting into and how it could perform, so that you don't have any surprises and going in that you're okay with whatever outcome happens. The last thing we want is for someone to say, I feel like I missed out on X% of return. We want them to say, yep, I knew that I had the potential to quote unquote miss out on something hitting a home run, but in exchange for that, I also had the peace of mind knowing that my portfolio was not going to go down 50% this year. So it's just trade-offs, and that's what we have to balance as financial advisors and investment advisors, is how our clients need their portfolio managed in line with their goals. That's why it's so difficult to pick these concentrated investments for everyone. It just doesn't make sense. So if you're working with an advisor that's a stock picker, that's going to be super tough. I'll talk about that here right now. I put in the question here. So after going through all of this, why do advisors generally recommend diversified portfolios? Don't they have time to research every available investment out there? Short answer on that is no, absolutely not. And the longer answer, and I broke it down into about 5 bullet points, is that the first one is the timing of an investment. If you get, a stock, right, that you really like and you recommend it to one client and it pops, it goes up, then they tell their friend. Well, by the time the friend comes to the investment advisor and says, hey, my so-and-so made 100% or whatever the number is on this investment, I want the same thing. Well, it might not be a good investment to do that in that same investment that investor number one bought. So it's not easy to scale it, unless you're running like a hedge fund or something like that, where everyone's dollars is in the same investment. And I'll talk about a hybrid approach later, but it just doesn't make sense for a common financial planner or financial advisor to do that and put a client into a stock pick. It just doesn't make sense. The second one is the volatility, the sheer volatility. A lot of my clients are in retirement or on the cusp of retirement, and I already mentioned this, they don't want the huge swings in their portfolio. Generally speaking, they're okay with giving up some return in order to mitigate some downside risk in their portfolio. So that's the second one. And the third one, I wrote in my notes that generally speaking, clients' goals are to make sure they never run out of money and they can just live a fulfilling life. They have peace of mind. So that said, that usually doesn't mean that they're going to try to hit the lotto in terms of investing. For some people, though, I do have clients I have clients all over the board in terms of risk tolerance. And I do have some people that hold individual stocks and they're retired, and they just understand that there is volatility that comes with that. And they know that they might not even get close to beating the market, and they know that they might crush the market in terms of returns. However, I have clients that say, hey, look, let's set aside some dollars in the portfolio and we'll put that as fun money that we're okay losing. And we will take extra risk with that in the hopes of beating the market with that smaller portfolio. And that's okay. I'm generally open to all ideas, or at least exploring all ideas when it comes to ideas that clients bring and things like that. But we just want to make sure that step one is that they're never going to run out of money and that their plan will be successful, even if we do segment out some dollars for speculative investments. The fourth one, and this is important, is that mentality of waiting for the dust to settle or waiting for the perfect pitch. And that's another kind of Warren Buffettism, is he's like, no, you just wait for that perfect fat pitch. And it's like, well, wait a second. His analogy is that you're not penalized if you don't swing. It's like, okay, well, not everyone is a billionaire that can afford to do that. Compound interest is what people need for the everyday investor, and they can't get that if they're just sitting in cash waiting for a pitch, waiting for their perfect pitch. So common investors that sit in cash and try to time the market or a certain investment almost always underperform, never get it right, and they underperform the investors that are just saving money every week or month. And this is really true in the digital asset space and the crypto space right now. A lot of people use it as quick trades, get in and out. And when I tell them, like me personally, I just buy new digital assets and cryptocurrency every week. Just every single week, no matter what the price is. I understand blockchain technology and things like that. And I'm just, in it for the long term. And people are like, wait, you buy every week? I'm like, yeah, absolutely. Because it just takes the emotion out of it. Whatever price I get, and I know that I'm not going to sell it anytime soon. So I just let it go. And the fifth one, it's not worth getting sued. right? If we're going to put a client's life savings in one thing and that goes sideways, the client will sue us, and it just isn't prudent and practical investment management theory, and it's not right for the client. And at the end of the day, I'm a fiduciary, so we have to look at all options that might be right for clients when it comes to investments, insurance, annuities, anything. So it's just not worth getting sued and losing the business because of trying to time things and pick different investments. All right, so let me wrap up with which strategy might be right for you. As always, I talked about this last time, is that generally speaking, a hybrid approach is correct for most people. So it might vary based on time horizon, it might vary based on age, et cetera, et cetera. For younger investors, maybe they could have, and here's what I do. I have certain accounts that are dedicated. They get weekly money or monthly money that are for long-term retirement assets that just track indexes and track the market. I have separate accounts that also get weekly dollars that are more speculative. And I know that before I make those trades that I'm okay with losing that money, because that's what it could be, right? It could go down 50%. It could go up 100%. We don't know. But before you get into an investment, it's important to know how that could potentially perform. And you have to understand that if it is in line with your time horizon and in line with your risk tolerance, you have to gauge that on whether it's appropriate. For investors on the cusp of retirement or in retirement, that percentage breakdown in the hybrid strategy of, more diversified investments versus concentrated investments might be different than a younger investor. An investor in retirement might allocate fewer dollars toward a speculative strategy. But again, I have clients that are 50s, 60s, 70s that are like, look, that's cool. Let's just use a portion of my portfolio and try to make it grow more than the market. And again, I'm going to wrap up with this. I've said it 5-6 times throughout this episode that as an investor, it's important to know that whatever strategy you go with, right? It's not that one is necessarily worse than the other. It's just that many people don't know the outcome of what their actions will be. And they just read articles online and see these lotto tickets get punched. And that's not the most realistic thing, and it can be detrimental to life savings. So it's important, again, to realize what you're investing in, what would make sense for you, your time horizon, your amount that you're saving, how long you're going to work, and really get a handle on the goals as you move forward throughout your financial plan. I hope you enjoyed this episode. If you would, please leave a 5-star review if you're enjoying the content. I know the largest platform that our listeners are on is Apple Podcasts, so if you leave a review, that would be awesome. I will catch everyone next time. Thanks for listening.